Good evening. I would like to take a few minutes of tonight's agenda just to cover the financial statements for our fiscal year 2012. And of course, our year end ends February 29th, so it's February 29th, 2012. And as with past meetings, I will not be going through the individual financial statements item by item, but rather what I'd like to do is share an overall analysis of this year's financial results. And then when I close, what I'd like to do is close with an overview of some of the projects that we're currently working on, because we believe those will also enhance the value of the cooperative to its members. So let's get started with net earnings and sales. Net earnings. On the statement of operations as presented in the annual report on pages 12 and 13, you can see that we ended the fiscal year 2012 with $13.3 million in overall net earnings. When compared to prior years, you can see that the current year's net earnings are the best in the past 5 years. So all in all, we had a very successful year. Our grain and supply sales. Total sales for the fiscal year 2012 were $419 million. That's an increase of $104 million over the previous year. And as you can see in the illustration, this was our second best year in sales in the past 5 years. And now I'd like to focus on what drove our financial success this past year by focusing on our business units. Grain operations. Our combined grain sales volume for the fiscal year 2012 was 35 million bushels of grain sold, a decrease of $5 million from the previous year, mostly due to a reduction in fall grain receipts, which amounted to about 11 million bushels. However, our grain business operations again achieved net earnings ahead of expectations, with an overall increase in grain revenues of over $1.98 million over the previous year. Agronomy operations. We ended the fiscal year 2012 with fertilizer sales of 77,000 tons. That's an increase of 12,000 tons over the previous fiscal year. We believe the increase in sales volume has a direct correlation to our service and our efforts in assisting our customers in managing their input price risk. Our crop protection and seed sales were $19 million for the fiscal year 2012. That's an increase of $1.8 million over the previous year. As with previous years, we continue to increase our market share and overall footprint in agronomy. Energy operations. Because of the fall drought, we saw our first decrease in petroleum volume in the last 5 years. We ended the fiscal year with sales of 18 million gallons of petroleum, a decrease of approximately 500,000 gallons from the previous year. But despite this drop in volume, our energy business unit ended the year with a strong performance, within 16,000 of last year's gross revenue. Feed operations. Our feed business unit, which includes Countryside Feeds, also ended with another successful and profitable year. Although our feed tonnage sales of 123,000 tons was off 6,500 tons from the previous year, we experienced an increase in overall gross revenue of $434,000 over the previous fiscal year. Our patronage allocation for the fiscal year 2012 is summarized in the annual report on page 14, and you can see it also has the individual patronage rates by commodity. And because of our cooperative structure, our members will share directly in this year's financial success through patronage dividends. For the fiscal year 2012, MKC allocated $5.9 million in patronage dividends back to its members, as well as over $24 million in the past 5 years. Overall, this year's patronage allocation marks the second best year of patronage, second only to the fiscal year 2009, and slightly ahead of the 2011 allocation. As we assess the financial condition of the company, we need to be reminded with any growth company, which would include MKC, it will always be a challenge to balance the demand of customers, creditors, equity holders, as well as lenders. Because of that, your directors spend a significant amount of time evaluating working capital needs, earnings expectations, capital expenditures, credit requirements, as well as equity decisions. Your balance sheet and overall financial condition reflects the efforts of both management and directors in balancing those expectations as well as demands. Total assets on the balance sheet. If you look at the balance sheet on pages 10 and 11 of the annual report, as you can see, our total assets for the fiscal year 2012 decreased from $301 million from the previous year to $209 million in the current year, a $92 million decrease from the previous year. Our decrease in total assets were both grain-related and twofold. First, we had a decrease in grain receivable of approximately $18 million from the previous year. Secondly, our grain inventories on hand were approximately $85 million lower than the previous fiscal year end, both a reflection of fewer bushels owned and sold near year end, all expected when you have a decrease in fall harvest by about 11 million bushels. Capital expenditures. Our capital expenditures for the fiscal year 2012 were $8.6 million. That would include all expenditures and new projects for elevators, as well as equipment for all business units. As you can see in the illustration, the aggregate capital expenditures over the past 5 years exceeded $30 million. And when you consider the annual maintenance and repair costs, which averages about $2.5 million per year, this organization has invested over $40 million in assets in just the 5 years, in the past 5 years. A significant reinvestment into the assets and future of this company. Cash return to members. Your directors and management spend a significant amount of time discussing member equity issues and the amount of cash to be returned to the membership, and take a very deliberate approach in balancing the equity needs of the company and the expectations of the members. For the fiscal year 2012, your company returned nearly $3.1 million in cash back to its members in the form of equity redemptions and cash patronage, and nearly $13.2 million in the past 5 years. Again, clearly separating MKC and the cooperative business structure from our competition. Working capital. Our working capital position demonstrates our overall financial strength and provides lenders and creditors with lending confidence, particularly during times of volatility. For the fiscal year 2012, we ended the year with consolidated working capital of $26.7 million, an increase of $3.5 million over the previous fiscal year end. As you can see, your directors and management have taken deliberate steps to strengthen our financial position over the past few years. Both directors and management believe these efforts will allow us to accomplish our strategic goals and strengthen our relationships with creditors, members, and lenders. I'd also like to review one financial ratio with you tonight. Return on equity. Return on equity measures the financial performance or earnings of the company against the investment from its members. And while not a record for the organization, our return on equity for the fiscal year 2012 was 21.4%. And from our perspective, demonstrating that we believe returning financial value to our customers and members is one of the most important things we can accomplish for our membership. Lastly, I'd like to update you on some of the current projects we're working on to further enhance the value of the cooperative to the membership. Patron Investment Program. The directors are evaluating the limits they have placed on the Patron Investment Note Program. An increase in the patron note limit would allow those members currently on a waiting list or others to increase their investment in new assets and the overall growth of the company. Software enhancements. We made a big commitment this past year with the implementation of a new business software platform. For the next few years, we will be focusing on improving the accessibility of this system and information to the customers. We also are pursuing a private letter ruling from the IRS in regards to the Domestic Production Activities Deduction, or Section 199, and how it applies to our cooperative. A private letter ruling is simply a written response by the IRS to our cooperative clarifying their position on a specific tax issue. If we get the response we are anticipating, we are looking at having access to a special deduction for the benefit of the cooperative as well as its members. And based on the financial information from last year, this deduction would amount to about $3 to $4 million annually. This deduction could be utilized by the company or passed through to its members and used on your personal income tax returns, or a combination of both. This would be a significant economic benefit to our cooperative and membership, potentially an annual reduction in income taxes of $1.3 million for the membership and the company collectively. And it is worth noting that part of the bylaw changes we are asking you to approve later tonight will allow the company to utilize this deduction and pass it through to its members. And yes, I am soliciting your support for the bylaw change later tonight because this is just too good of a deal to pass up. We certainly don't want it to pass through or slip through our hands. And I know I've taken more than my allotted time, so in closing, I would just like to thank you for your business as well as your support you have given us this past year. Thank you.